Most homeowners in Switzerland make a financial decision when they buy a property in Switzerland, and it costs them tens of thousands of francs over 15 years when they sign their mortgage. By the end of this video, you will know which option saves you thousands of francs in taxes and which you should prefer. I'm a former banker and a mortgage broker. We are specialized in mortgages. We work with 30 banks, so we know what we're talking about, and let's dive in. Swiss mortgages are divided into two parts, a first mortgage and a second mortgage. The first mortgage is 65% of the property's value, and the second mortgage is 15% of the property's value. Now, the first mortgage, it's very special in Switzerland. You don't have to pay it back. So you just need to pay back your second mortgage, this 15%. So you'll see 80, 90-year-old people with still having a mortgage. Your second mortgage needs to be paid down within 15 years or till retirement, whatever comes first. Meaning if you're 60 years old, you will need to pay back your second mortgage within 5 years. And if you're 30 years old, you have 15 years time. So that's not a choice, this is mandatory, it's a Swiss regulation rule, you don't have a choice. And now the question is, how should you do it? Should you do it directly or indirectly? Let's talk about it. With a direct amortization, you pay back the bank every year. For example, all 3 months your mortgage deducts for, let's say, you have an amortization of 10,000 per year, and all 3 months 2,500 francs are going to be deducted from your mortgage. So your debt shrinks every year, it becomes smaller and smaller, and when your debt shrinks, you will also pay less interest on it. Sounds great, right? But there's a catch. Currently, Swiss mortgages, if you pay interest, it's tax deductible. So you should take a closer look, because less mortgage interest means less deductible taxes, which results in more taxable income for you, and you will have to pay more. And also the imputed rental value stays the same no matter how low your mortgage is. So with direct amortization, your tax bill will increase every year, and maybe that's not in your favor. The second option is the indirect amortization. You pay every year in your Pillar 3A, instead paying it down on the mortgage and paying it back to the bank. The bank pledges your Pillar 3A as collateral, it's just a security for them, and your mortgage balance stays the same. Over 15 years, your mortgage balance stays the same. You will also pay the same interest amounts, and what happens is you will do your duty by amortization by paying in your 3A pillar account, meaning mortgage stays the same, 3A goes up, up, up. This means your mortgage interest deductibles stays at its maximum, and there's the bonus number 1, your 3A pillars, what you're paying on it, are also deductible from your taxes, and bonus 2 is the money on your Pillar 3A grows without taxable gain. Meaning if it grows and grows, you can also invest it in ETFs. This is totally fine for the banks. Most people don't know that. It can grow tax-free. You don't have to pay taxable gain while it's growing. At the end of the term or when retirement arrives, a lump sum will be paid out to the bank to reduce the second mortgage. When the lump sum is paid out, you need to pay taxes, but it's usually much lower than a normal tax you would have to pay. And the very important thing is you are able to invest your Pillar 3A in ETFs, which are exclusively designed for the Pillar 3A. And so you will have over 10, 20 years a return of 5 to 7% depending on your strategy. So you have the maximal amount you can deduct for your interest, you pay in your Pillar 3A, you invest it, and over 10, 20 years, I mean, you don't have to be Warren Buffett to understand this. Well, which one is better? The Indirect amortization isn't always better. It really depends on your taxable situation, and it's very individual with every person. If your marginal taxes is low, the benefit also shrinks. If you're close to retirement, you won't have as much time to invest it, the third pillar. The pillar 3A amount is locked until 5 years before arriving the age of retirement, or you can withdraw it if you leave Switzerland, you can withdraw it if you make renovations or pay back your mortgage. If you're an American, there might apply some different rules, so get in touch with us or with your tax advisor. Now, it's very important that the Swiss have made a decision that this Eigenmietwert is going to be abolished, and it has a change, an impact on everybody. The implementation will be expected in 2029. You won't be able to deduct the interest rates, the interest payments from your taxable income, and also renovations you're doing, you won't be able to deduct it from your taxable income. Also, the imputed rental value is going to be abolished. So that's also something positive, which most people liked. So there will be a change. There is a difference for first-time buyers. There is a different rules. I will make a different video about it. And now, if you have a mortgage or you're planning to buy a property in Switzerland and you really would like to have someone who can guide you through everything, and then someone who can get you a good rate for your mortgage, because if you're buying for the first time, everybody says something different. You look a lot of YouTube videos, you're on Reddit, you go on Google, but you feel kind of lost, and you need someone who guides you through every step so you don't make costly mistakes. And if you just want to feel safe without making a mistake, who is better than former bankers, your mortgage brokers? Click now on the link down below, fill out the forms. One of our team members will get in touch with you and see if we are able to help you, and then we can schedule an online meeting. It's very easy, and then we will help you and you won't have to do anything. So see you.